welcome back after lunch. My name is Michael Ndegwa. Initially, this session was to be chaired by my colleague, Sarah, whose flight was cancelled the last minute because of the fire in Heathrow. So I have to chair and then present her work. The only thing I'm not able to do is to be the discussant, but she already reached out to the authors of the paper she was to discuss and shared her comments. So I think that will be good. All right, so we have 30 minutes for every presenter, 20 minutes for presentation, 5 minutes for the discussant, and 5 more minutes for question and answer, which we need to stick to. So if I raise a red, yellow, you have 5 minutes to go, and a red means you have 2 minutes to go. So we start with our colleague here.
Great, thank you everyone. Thank you for coming to this session. So my name's Emma Riley. I'm at the University of Michigan, and this is joint work with Rachel Heath at the University of Washington. And our paper is Digital Financial Services and Women's Empowerment, Experimental Evidence from Tanzania. So women's empowerment is not only a key goal of policymakers, but it also has important effects on economic outcomes. And many programs therefore try to raise women's empowerment, but most of these have focused on doing so through increasing women's income. So the idea being if you raise women's income, then women will have more bargaining power in the household and hence more empowerment. However, women's empowerment can only increase when they have more income if they retain control over this income, right? So if they're not able to actually decide how to use this income and manage what it's spent on, then their empowerment is not going to increase. And so it's vital that not only do we look at how to raise women's incomes, but also how to make sure that they retain control over that income. And so digital financial services have been highlighted as one way through which women's control over their money could be increased. So digital financial services, mobile money being a very well-known and popular one, can raise women's control over their money by giving them a sort of safe, secure, private place to keep their money. However, one key limitation on sort of digital financial services' ability to increase women's financial control is that there are large gender gaps in women's use of digital financial services. So only just over a third of women in sub-Saharan Africa use mobile money, kind of one of the most popular digital financial services, whereas half of men do. Not only are women less likely to use mobile money services, but amongst women who do use them, they use them less often, they make fewer types of transactions, and they make much lower value transactions. And one of the key ways that you might think women could sort of maintain control over their money is potentially through saving on mobile money accounts. But only a third of women save on mobile money compared to over 60% of men. So in this paper, we're going to be asking whether increasing women's use of a digital financial service, mobile money, can improve their financial control, so can increase their control over their money, and whether this subsequently raises their empowerment and improves other outcomes for women. We do this using a randomized control trial with just over 150 female microfinance groups in Tanzania. And very briefly, what we're going to be doing is we're going to be increasing women's use of mobile money services through changing the loan repayment of their microfinance loans from the usual method, which is they pay in cash every week at a group meeting. And instead, we're going to be switching their loan repayment to be via mobile money. We're not going to be changing anything else about the microfinance loan. So women are still going to be meeting every week in their groups, but just instead of paying as cash, they're going to be making their repayment using mobile money. Everything else is remaining the same. The loans are given out as cash. We're keeping that. They're still having the loans dispersed as cash, and we're not changing anything else about the group meeting structure. And then we look at impacts on use of mobile money services, women's empowerment, savings, loan, business, and household outcomes after about 9 months. So to give you a brief preview of what we find that treated women, so women in microfinance groups which switched from loan repayment as cash to loan repayment via mobile money, see a large increase in their use of mobile money. This is not just mechanical, this is other use of mobile money beyond the loan repayment. So they start conducting larger value transactions with mobile money, making more frequent mobile money transactions, and importantly, they start saving with mobile money and saving a lot more with mobile money. Women are also more comfortable using mobile money, and they're more likely to make transactions by themselves using mobile money. Secondly, we see that women's empowerment increases. So women in the treated groups have increased levels of financial control measured by both self-reported and experimental measures. They save more in all forms. They have greater decision-making in the household. And consistent with this increased decision-making, we see that expenditures shift in some ways towards goods which women might have a higher preference for. Importantly, despite increasing women's control over their money and raising their empowerment, we don't see any evidence of a backlash. We don't see any increase in arguments within the household or any evidence that women are suffering as a result of this improvement in their empowerment. We don't see any effects of treatment on women's businesses, household income, or total consumption. So we're only seeing effects on mobile money use and women's empowerment. We also importantly see no changes in loan repayment behavior. So the shift from cash loan repayment to mobile money loan repayment is not affecting kind of default on the loan or likelihood of taking up subsequent loans or any other aspects of loan behavior. So our study makes two important contributions to the literature. Firstly, we show that increasing women's use of digital financial services can increase their control over their funds, improve their ability to enact their preferences in the household, and raise their empowerment. And this is really important because other studies have suggested that control over funds is a really key part of women's empowerment. But most studies have not been able to isolate control over funds by itself. So most studies that have looked at women's empowerment have often found there's been changes in the income of women or changes in the woman's relative economic position within the household as well. And so you can't isolate the change in control from the change in income. In our study, we're isolating really that change in control because we see no changes in income. So we're able to say that a change in control over funds by itself is sufficient to increase women's empowerment. Secondly, we add to the literature on the benefits of digital financial services. There's quite a large literature now just showing that digital financial services have many benefits to the household. We show that digital financial services can also benefit women through increasing their empowerment and crucially through increasing their ability to save. There's sort of mixed evidence on whether digital financial services can improve savings. We see that they can in this case. And that those improved savings are important for allowing women to save up for more lumpy types of expenditures. It suggests that sort of experience and having to conduct repeated transactions is important for increasing women's comfort with digital financial services and encouraging them to use them for more and more types of transactions. So I'll briefly go through the experiment design in a bit more detail. So our sample is 152 microfinance groups from 7 branches of the NGO BRAC in Tanzania in the Mwanza region. All of these microfinance groups consist solely of women. That's the standard structure for these groups. The groups are about 25 women. They meet together in their communities. Women get individual liability loans, but they meet together every week in that community to make repayments for these loans. We randomly selected 5 out of the sort of 25 women on average in these groups to take part in the study and to be surveyed in the study. A bit of context here is that because this is a selected sample in the sense that these are all female entrepreneurs getting microfinance loans, nearly all of them had previously used mobile money. So the important dimension here is not going to be sort of not using mobile money to start using it. It's really going to be about intensity of use, like how they're using it and to what degree they're using it. Previously, most of these women had only ever used mobile money for sending and receiving remittances. They're not really conducting sort of higher value or more advanced transactions like allowing customers in their businesses to pay with mobile money or saving with mobile money. So we randomized at the microfinance group level 51 groups to control and 101 to treatment, and stratified by some key variables. The data that I'm going to be showing you here comes from two main different sources. Firstly, a baseline and end-line survey took place in person, and they were 9 months apart. We also have administrative data from BRAC on the method of loan repayment for every week of the study, and also on loan outcomes such as default on the loan and subsequent loan access. For time reasons, I'm not going to show you, you'll have to take my word for it, but the randomization was well balanced and attrition was extremely low, only 3%, and did not differ by treatment arm. So what exactly was the intervention? So we switched the loan repayment from cash to via mobile money. As part of this, women were given, I call it a training, but really it was sort of a brief amount of information specifically on how they made their loan repayment with mobile money. So that involved them being given a short code that they used to actually send the payment to, and instructions on how they find their sort of loan ID, so they can provide the ID number as part of the payment, so that it can be linked back to them. So they were told this information and sort of demonstrated how they could do this on their phones. The training didn't go any more beyond this. All of these women had in principle used mobile money before, so it was quite brief and very focused on making the loan repayment. Women were then encouraged to make all subsequent loan repayments using mobile money. Importantly, these women were sort of in different stages of their loan cycle. So once their group shifted to mobile money loan repayment, wherever they were in that loan, they could start making the loan repayments with mobile money, and subsequent loans, they also could continue or keep going with making loan repayments with mobile money. Women had to pay a 1% fee for making the loan repayment using mobile money. That was charged by the mobile telecoms company. It wasn't charged by the microfinance organization. So there wasn't a way to avoid that fee. Importantly, we didn't change anything else about the group meetings. So women had to still attend in person every week. And the loan disbursement didn't change. That was still done as cash. The control group, nothing changed. They continue to make their loan repayments as cash at the weekly group meetings. So firstly, just to show you what take-up was like, because women had to pay a 1% fee, a key question is like, did women even want to make their loan repayments with mobile money or not? And so we see that out of 22 loan repayments on average, women made around a third of them. It's about 8 of their payments using mobile money. Since I only have 5 minutes, I'll dive straight into the results. This is an RCT, so very simple. We're doing intention to treat and COVA specification, where we're regressing the outcome of interest on an assignment to the mobile money treatment at the microfinance group level, controlling for the baseline value of the outcomes, using LASSO to select controls, including stratification, fixed effects, and clustering the standard errors at the microfinance group level. And everything I'll show you is pre-specified in a pre-analysis plan, including index construction. So the first result is that we see treated women, so women whose group shifted to mobile money loan repayment, see large increases in their use of mobile money. Column 1 shows an index which summarizes columns 2 to 9. The index increases by 0.34 standard deviations. It's a large increase that's being driven by treated women being more likely to allow customers to pay with mobile money, being more likely to make a mobile money transaction each week, having much larger value of transactions, sort of $35 a month, higher transactions, being more likely to save with mobile money, and having more than double the amount of savings compared to the control group. Consistent with this, there are increases in comfort with mobile money. So an index of comfort in column 1 increases 0.16 standard deviations. This is sort of driven by comfort making different kinds of transactions, particularly being able to reverse a transaction and send money, but also by women being more likely to make mobile money transactions entirely by themselves. And we see no change in trust in mobile money or problems using mobile money. Women's empowerment increases substantially in the treated groups. So in column 1 here, I'm showing an overall index of empowerment, which here is composed of 4 underlying indexes: financial control, permissions, requiring permission to do different activities, household decision-making, and business decision-making. We see that women in the treated groups have large improvements in financial control and in household decision-making. So I'll dive into those 2 now. So financial control, again, in column 1, I'm showing you an overall index of financial control that increases at 0.37 standard deviations. It's a large increase. And it's really driven by every component that we pre-specified that we would put into this index. So we had 3 self-reported measures capturing sort of, do women say themselves they can decide how to spend their own income? And then a series of incentivized games measuring willingness to pay to control money. And all of these improve. So large improvements in financial control. We also see large improvements in household decision-making. So again, the index increases sort of 0.22 standard deviations. This is driven by women making more decisions around clothing and food purchases, and also just saying they're more involved in all the decisions, even if they're not the sort of final decision maker. Okay. We see, importantly, no changes in women's discord with their spouses or in their well-being that suggests there's any sort of backlash from these empowerment improvements. Consistent with the increase in empowerment, and importantly, this was not pre-specified, but sort of exploratory analysis looking at expenditure shares, we see that actually the amount, the share of expenditure going towards snacks and treats declines, whereas the share of expenditure going to school fees and school supplies actually increases. And this could be suggestive that there is actually a shift in expenditure towards things that women value. We don't see any change in total household income, consumption, or food consumption. We see that women are not only saving more in their mobile money accounts, but that there's actually an increase in their total savings in all sources, which could be suggestive of some kind of crowd in of savings. So total savings of the women increased $64. $15 of this is mobile money savings, but actually all the other components of savings also increased. So we think we have strong evidence that at the very least, the increase in saving in the mobile money account isn't crowding out other forms. If anything, there's a small crowd in. I won't have time to show you today, but there's no other changes in loan outcomes. We have all this administrative data, so we can look at a variety of loan delinquency outcomes. We see no changes there. We also don't see any changes in kind of social cohesion within these groups. And then lastly, we don't see any effect of treatment on the women's businesses. So here in this figure, I'm showing the monthly profit in the women's business. The control line is in red and the treatment line is in green. And really for every single month that we measured profit, there's just no difference between the treatment and control group. So there's just no impact on the women's business. And that also holds if we look at other business outcomes like sales or expenditures. And consistent with that, we see no changes in income or consumption. So just to wrap up, we show that inducing women to use mobile money for their loan repayments results in women using mobile money substantially more. They're more comfortable using mobile money. They're more likely to use it by themselves. And they make much larger transactions with mobile money. They save more on their mobile money account and save more overall. And as a result of this, women's financial control increases. So they're more able to say how they use their income and how they spend their income. And women's decision-making within the household increases. Consistent with this, expenditures also seem to shift towards women's preferences. There don't seem to be any negative consequences of this in terms of both spousal discord, also any other changes in household outcomes. So we think this is suggestive that shifting from payments being in cash to payments being in a digital form has important positive effects on women and women's empowerment. So thank you very much.
All right. So my job is to provide some brief comments on this paper. So overall, I think it's a really interesting paper. And the thing I like about it is that the experimental design is very clear. And the paper is also, extremely good in terms of the writer. So in terms of the strength, right? So basically what the paper is showing us is that, DFX has a role, in terms of promoting women empowerment, right? And the nice thing is that unlike other cities where basically, their resources based on this experiment itself, here they have very good admin data to be able to back out, a lot of the results. But anyway, I guess my job here is not just to tell you the nice thing about your paper, but I had 2 or 3 key points. The first one, and perhaps the most important one, is really about the intuition behind this, right? So as you showed, a lot of these women were already using mobile money, right? About 97% of them were already using mobile money. And if I understood the paper correctly, the intervention is really about an encouragement. It's more like an encouragement design, encouraging women to repay their loans using mobile money. And if I understood correctly, they had the option of opting out, right? So then the thing I was trying to wrap my head around is given that these people are already using mobile money, in a way, presumably you can assume that they understand the benefit of mobile money. And it's not a new technology to them. But by encouraging them to pay their loans using the mobile money, it's able to induce a lot of these nice effects, which we are always, it's a very nice effect that we want, right? And so if we take a step back, what could be the main policy lesson we could learn from it? Could we get a similar results by inducing advertisement of mobile money, right? Or there's something specific about loan repayment per se that will more or less generate these results, right? And so at least in the version of the paper that I had, it wasn't very clear to me. And so I think it's a very important point that has a lot of policy implications. So maybe all that we need to do, because in many countries, uptake of mobile money is really increasing, right? And so once we reach 100%, is that just enough, or there needs to be more advocacy in terms of ensuring that there's increased utilization of the mobile money? The second point was also, so at some point, if I understood it correctly, again, you did some preference survey, and despite the women taking up 64% of them saying, adopting the intervention, when you survey them later, a lot of them also had zero preference of using mobile money afterwards. So then it was kind of puzzling to me that, was it that they felt a bit more compelled to use the mobile money? Or maybe it was related to the cost. After paying the 1% extra, they realized that maybe, I ended up paying a higher APR than what I would have used if I was just paying by cash. And so I wanted to hear your take on that. The last one was really on how the indices were created. It wasn't specified, but I think that's more or less like a minor point. And the last one, I think I've talked about it in terms of what is really the policy message that we are getting from here. Is it more advertisement, or ensuring that there's a lot more vendors are actually taking up mobile money, so that when people go to their shop to purchase things, or even the banks, allowing people to pay for their services using mobile money? Let me stop here.
Great, thank you so much. They're really, really good comments. So thank you. So I think I'll just speak to a couple of them and then open the floor to questions. So I think your first point was that in a sense, the treatment was quite light. It was an encouragement. And so why does that shift so dramatically women's use of mobile money and for like other types of transactions? I think it's really about an equilibrium where you're sort of entirely cash-based, and then you're trying to shift to an equilibrium where you're using more digital payments. And I think that it can be very difficult to start using digital payments a lot more intensely if like no one accepts these forms of payments, and you have no need to sort of put money on your mobile money account for making payments because no one will accept them. So you need to have some kind of like push to actually start to keep money on your mobile money wallet so you can make payments. And in this case, it was the loan. Because women had to make the loan repayments every week in their businesses, they were now more willing to accept payments with mobile money because they knew they could just keep that money on the wallet and use it for the loan repayment. And alongside there, they just started kind of storing more money in general on the mobile money wallet because they knew they could always use it for the loan repayment. Whereas previously they would have to cash out, and when you cash out, you also pay fees. So I think it's partly related to sort of the fee structure of mobile money, maybe like deterring people from starting to use it. But once you have a reason to kind of shift everything to digital, then you start using it a lot more substantially. So I think that the loan repayment really like just helped them shift towards using mobile money much more substantially for that reason. And that kind of links to your policy point as well, because you said, would advertising be enough? And my answer is no. Like as you say, mobile money is widely known. Everyone has used it, but they're not using it in sort of these more advanced ways for payments and for savings. I think to do that, you need payments to start shifting to digital. So you need to maybe receive government payments in a digital way. You need to be able to make government payments in a digital way. And as that increases, you get your loan with mobile money, you make your payments with mobile money, everything will shift to mobile money instead of cash. But until that happens, people won't just start using mobile money more intensely, or at least not many of them will. Lastly, I think you spoke to this important point about the preference for loan repayment. So we asked at Endline, what would your sort of ideal way be to make your loan repayments? Would it be cash or mobile money? And we saw in the treatment group that actually they had a lower preference for making payments with mobile money. We think part of the reason is we didn't word the question that well, in that I think the control group might not have been very aware they'd have to pay the fee if they made loan repayments with mobile money. And the treatment group obviously did know they would have to pay a fee to make loan repayments with mobile money. And they did not like the fee. So despite the fact that they said, they did make their payments with mobile money and were happy to do that, they had a strong preference for the fee sort of being removed. And I think when the treated group answered this question, partly they were under the impression if they said how bad the fees were, maybe BRAC would start paying the fee. And so that, I think, also slightly clouded their answers. And the control group were not thinking about there being a fee. And so I think that's why we got such a big wedge in terms of preferences coming through. But thank you. Really great comments. I think I have a few minutes for questions.
You can have one.
Okay.
Anyone? All right.
Thank you very much. It was really interesting. I was wondering whether you have the opportunity to explore the questions of networks. Whether was there any way some women who were in contact with the treated model who could react in the same way and adopt these services the same way that the treated model did?
Yeah, it's a good question. So we didn't really measure networks. So that, I mean, the way the microfinance group work is that there's normally only one group per community. So we weren't really worried in terms of any like spillovers between treatment and control groups. But it's certainly possible that women could have been interacting with their friends who weren't group members, and that could have changed mobile money use. We did not measure that. So we can't really say anything there. What we did measure was just like group interaction and sort of were women interacting. Well, one way that there could have been kind of spillovers within the group is that even women who didn't start using mobile money for loan repayment in the treatment group still were exposed to all their friends kind of using mobile money a lot more. So we actually do see that even women who technically didn't take up the treatment also started using mobile money a little bit more in the treatment groups. It seems like there were some kind of spillovers like within the treated groups, but we don't know anything outside of the groups. So I think I'm out of time. But thank you very much, everyone. Happy to talk after.
Okay, so from Tanzania, let's go to Kenya. I'm going to present to you a paper on the effect of government contracts on firms. And this is joint work with my colleagues Peter and Bernard. Bernard is somewhere in the corner there. All right, so I believe we all know what public procurement is. And if you don't, now with what is happening in the US, it should give us a sense of it, right? But it's a very popular thing in many countries. And it's essentially about the purchase of goods and services by governments. Now, the question is, how important are these? Well, some studies suggest that it's globally, the size of this procurement alone accounts for about 12% of GDP. And part of the reason why this seems to be important is that it's really the primary channel through which public funds flow to private enterprises, right? In a way, in some countries, particularly within the sub-Saharan African context, where, there are huge demand-side constraints, your ability to secure a government contract, in a way, helps you to relax that demand-side constraint, right? Now, in some countries, too, it's being used as an industrial or a social policy, right? So in Kenya, for instance, they have this policy which is called the Access to Government Procurement Initiative, which essentially favors small firms and firms owned by women and persons with disability in the award of public contracts and all that. Aside these nice things, we all know it's also a major avenue for corruption, right? There's a lot of clientele, activities going on in here. But that's not really what I'm going to talk to you about today. Today, what I'm going to talk about is when your business get a government contract, what happens to you? And that in a way explains why a lot more firms, particularly in developing countries, would try and do whatever it takes to be able to secure a government contract. So what exactly is the question? What exactly do we know about this question in the literature, right? So there's been quite an increasing number of papers showing how participation in public procurement, the effect on firms, right? So there's evidence in the US showing that there's a massive increase in productivity. That's a famous paper by Ferreira et al. In Brazil showing that it really leads to, increases in employment. And then in some instances, it helps firms to get access to credit. At a macro level too, there seems to be, an increasing number of evidence showing that indeed there's a relatively high multiplier, from these things. Now, in the sub-Saharan African context, despite the importance of these, there seems to be scant evidence. The only paper that I have seen so far, it's a paper by Hockman and San Filipino in 2018, where they used the enterprise survey to look at association between firm outcomes and then participation in public procurement. What we try to do here is to try to use admin data to try to test some of these questions. And so we look at how, the effect on in terms of firm productivity, employment, and even participation in the supply chain, the effects upstream. And then we also try to provide some, mechanisms. The data we use here is admin data that shows the business-to-business transactions of the universe of former firms in Kenya. And we have this data from about 2015 to 2022. And then we're able to, show this. Okay, let's spend some time and talk about the data. How am I doing on time? Okay. I hate to be bailed out. Okay, so like I mentioned, our data is admin data on firm-to-firm transactions. If you have any questions, there's a lady sitting on the corner. Verena, she will also be presenting another paper tomorrow or the day after using the same data. So you can direct all questions on the data to her. But essentially, it's a B2B data set, right? So you're able to know which firms does a representative firm trades with. What is the value of the transaction? What is the number of times that this firm trades with over time? So we use this data, and we are able to identify whether we also know the nature of the firms, right, or type of firm that is trading with. So we know whether it's a government firm, a private firm, whether it's a foreign firm, and then what have you. So we use this to identify firms that are trading with government, and to give you confidence. So the Kenya Public Procurement Authority also publishes the list of all firms that have ever gotten a government contract. Now, here, we use an approach by Amity et al., which basically we create a threshold. Because we are going to use an event study, we try to focus on important contracts, right? Winning a contract that is relatively sizable enough and try to measure the effect of that. So we have roughly about 76,000 firms, and just to about 1.5% of the firms in the data, actually participate in or have a serious or a substantial contract from the government. Let me spend a few seconds showing you some of the graphics from the data. So your left-hand side, these are the sellers by the various firm categorization, and then you have the buyers. So as you can see, as expected, local firms, which is essentially domestic firms, majority, about 98% of their trade is among firms of the same nature, right? Similarly, you see foreign firms also trading more with the local firms. So there's a tiny share. What we are going to focus on is this one, right? Which is about 2% of overall transaction that goes from local firms to government. So again, we focus on the private firms, and then when you dig deeper to look at the type of firms, recall that earlier I mentioned the first slide, I mentioned the Kenyan government policy that tends to favor small firms and firms with firms owned by women and persons with disability. And as you can see, I think roughly about 40% or so of and these are just the count of transaction, not the value itself, right? Roughly half of the transactions are with micro firms, which essentially firms with employment size of less than 5 per se. This is also the breakdown of the sectors for which the firms that are trading with government. It's mainly wholesale and retail, and then construction. And then if you dissect it by location, majority are based in Nairobi, Nakuru, and then Mombasa. Roughly, these account for about 85% of the trades with government. All right, now let's go into the bolts and nuts. So, like I mentioned, what we're going to do here is to use an event study. Now, ideally, if we had data, ideally in the procurement system where bids are competitively assigned, right? You could use whichever threshold that they use to assign to determine which firms win and those that don't. And you could simply even do, a regression discontinuity, right? Comparing those that barely made a pass mark with those that barely lost out. But in the real world, procurement is a mix of the competitive ones and sole sourcing, right? Plus, we don't necessarily have the data we will get from the Kenya Public Procurement Authority. We don't have information on those that lost out, right? And so in this data, what we're going to use here is we're going to use the first time a firm secures a major contract as the event time, and then with our event study, compare the outcomes before and after, relative to the control group. So this is our baseline estimation. So your left-hand side is the outcome. So this is the outcome of firm I in County J, in Industry J located in County M in year T. G here is a dummy that switches on from the time the firm becomes a government contractor based on our definition, and is 0 for the time before. We control for firm fixed effect, industry by time fixed effect, firm age fixed effect, and then county-specific time trends to absorb local changes in economic growth. For those of you who are following the difference in difference literature, I've lost count of the number of new estimators that are in now, but there are a bunch of them. What we try to do here is that all our estimations, our baseline estimation is using the Sun and Abraham. There are a bunch of threats to identification that for which the time master here will not allow me to go through, but just to give you the assurance that we take care of all of these, and I'll show you some of the results later on. So let's go to the results. So the first set of results, it's really about looking at the primary outcomes. So we look at the effect on sales per worker, value added per worker, and then we also try to look at what happens to sales to other firms. Now, as you can see, there's a positive increase in the impact on sales, right? Whether you use sales per worker, sales itself, value added or value added per worker, it shows a substantial increase. In terms of magnitudes, the value added per worker increases by about 27% over the first 4 or 5 years after becoming a government contractor. But the interesting thing here is to look at what happens to the sales to other firms. These are sales to other private firms. Now, what you see is that in the first year that a firm gets a government contract, the sales to all other firms drops. And this is consistent with the so-called venting out hypothesis, which basically says the moment you get a massive contract, you close your eyes on all other persons, and then you want to make sure that you make the person happy, right? But after that, sales to other firms bounces back. On the net, we find a net positive effect on sales to other firms. And the analysis we show later on will confirm that. Employment also increases. In the fourth year, it increases by approximately 10%. In the fifth year, it's still positive, except that the confidence interval is much wider, but it's significant at 10%. Right? What happens to the supply chain effect? So we look at the number of private firms that a firm trades with after becoming a government contractor. So the first chart that you see there, we see a positive increase. And this is the number of suppliers to that particular firm. So what this means is that once I get a government contract, I tend to buy more from other firms, right? Which is in a way showing a positive effect throughout the supply chain. The value of the purchases, the monetary amount also tend to increase, except that here the identification police might not be too convinced about that, right? Because there seems to be, some positive pre-trades. But overall, it shows that there's a positive effect. One thing that we wanted to do was to look at, okay, these effects that we are getting, can we find any benchmark, right? Now, for those of us who are a bit familiar with the firms and trade literature, you know that trading with a multinational, it's one of the most coveted relationships, right? And so what we wanted to say is, how do our effect compare in order of magnitude to the benefits that a firm gets by trading with a multinational? And so we replicated the same analysis, everything, except that this time, instead of buying from a government, you are buying from a foreign multinational. And the pretrends don't look as nice as in the baseline results, which is trading with a government. But in order of magnitude, on average, we tend to find effects that are similar. The gains that these firms get from trading with a multinational. Now, word of caution, I always put this caveat. I am not by any chance saying that this implies that trading with a government is more important than trading with a multinational, because trading with a multinational gives some additional benefits that are not actually captured here, including technology transfer and then what have you. But this is used as a benchmark to show us the extent of how important, this trading with government is, at least in the context of Kenya. 5 minutes or 3 minutes? 5, okay. All right, so let me try to convince you that the effects that we are getting here are not spurious. So one possible thread is that, if we believe the story, like I mentioned, it is not random. Getting a government contract is not necessarily random, right? Given that, like I mentioned, there's even a government policy that tends to favor certain type of firms. And so maybe then the effects that you are getting, it's really due to the fact that the government is pre-selecting high ability firms, right? And so how well should we believe your results? Well, so what we do here is that we try to run alternative specification in dealing with the selectivity issue. And so we do matching. So we match firms based on pre-treatment characteristics. And then we also do another estimation using the stacked diff and diff. And essentially in the stacked diff and diff framework, all the firms that will be treated firms, the only difference is in the timing of the treatment. And so if I can show you the results, so this is the results when you do the matching. It's pretty much similar to what you find in the baseline. This is the results from the matching. Now, somebody might be asking, why is it that the event window is too short here? And the reason is that when you are doing matching, so we have to use a 2-year window because you are using those who get treated in the 3rd and the 4th year as the control. And so that's the reason why the event window is short. But as you can see, pretty much, generally the result seems consistent. We also try to appease the various estimators that are coming. So we run a bunch of them, and if I can show you, these are the results when you compare with the various estimators, and the results seem to be fairly consistent. The final one was, if you recall, the definition of treatment was when the first time we see that the value of a government contract is at least about 15%, right? Now, that was an arbitrary threshold. So to convince you that the results is not really driven by the arbitrary threshold that we chose, we experimented, other thresholds. And as you can see, the results still seems consistent. Now, I believe I have 2 minutes, so let me shut up and go to the mechanisms. We think that there are about 3 key things that could be driving here, but we are only able to test 2. One is that I think what really is going on is that there's a lot of demand constraint in the system, right? And so if you get any credible buyer who is able to give you, demand for your services, it's great, right? Now, how to test that, I'm not too sure. But the second one is a credit channel. In many countries, governments are seen as a credible, borrower, right? So the moment government owes you, they will always honor. And to quite recently, where we've seen some governments are defaulted, but I think overall, government seems to be a credible borrower. So whenever you have a government contract, it's easy to get, more or less a loan from a bank, right? And so we use the enterprise survey to show you some correlations, and we find that firms that participate in procurement activities are more likely to get access to credit from the banking sector. The second one was resilience to shock. And here what we did was to try to do some experiments. So we use, the most recent big shock that we all know is COVID, right? Now, COVID also induced a lot of purchases from government. But what we do is that we restricted the sample to firms that ever got a government contract before COVID, right? We dropped those that got a contract during COVID, and then we try to look at what is the performance, the difference between those that participated in a procurement or got a government contract before COVID versus those that did not, right? And look at the effects over time. And we saw that, for those that had prior, contract with a government contract, with a government agency, tend to perform well when the COVID crisis hit. So just to summarize, essentially what we're showing here is that, and there's no reason why, a lot of firms tend to chase after government contract because it tends to have, some benefit to the firms. 2 takeaways, like I mentioned, I think what really this is saying is that any uplift in demand it's going to be beneficial to firms because they can really increase their capacity utilization. But also on face value, if we take these results from face value, what it basically says is that if we're able to improve efficiency in public procurement, these gains could be, efficiently distributed in the economy and not just concentrated on few firms that have some connections to the government. So let me stop here, but thanks.
Yes, it was a pleasure to read this paper. Justice didn't mention this, but this paper has been accepted to the Journal of Development Economics. So there is limited scope to make a lot of suggestions on the technical side. So as he mentioned, government purchases account for 12% of GDP, so this is an important topic. And he explores to what extent government procurement contracts can be transformational for the firms that obtain those contracts. So how do these demand shocks affect the private sector? And what is the impact of winning a government contract for a private firm in Kenya? And he also explores what are the mechanisms through which firms are impacted by government procurement and develops a quasi-experimental design event difference in difference study to provide causal evidence, where he does both stack difference in difference and match difference in difference. And the evidence is that sales are boosted by 73% in 4 years, which is quite substantial, and productivity 25% yearly for the treated firms, and the increase in employment is 10% over 4 years for firms that obtained a government contract. And there is an initial decline in sales because the firms devote their installed capacity to satisfying the government contract initially, but there is a subsequent rise on both the extensive and intensive margin, so the number of partners and the volume per partner, with other firms beside the main client, which is the government. So there is a sort of crowding in or multiplier effect, if you wish, whereby there is a complementarity here that is well documented. So they mention that the benefits are comparable to supplying to a multinational corporation subsidiary, and he showed the results that the magnitudes are similar. And my main comment is related to that, and I'll come to that in a minute. But before, on the mechanisms, government contracts relax liquidity constraints as the government is a reliable customer, and treated firms get 18% more access to credit and control firms. And it also boosts their resilience. During the COVID-19 pandemic, government contracts provided a cushion against adverse macroeconomic shocks for these firms. So the analysis consisted of both the staggered difference in difference and matched difference in difference, comprehensive robustness checks. The causal link is solid. And my main comment would be to establish a connection, and here I will engage in some shameless self-promotion with the literature on FDI spillovers, where the seminal papers are listed here. Kugler, 2006, that was my PhD dissertation paper in 2000, which appeared in the Journal of Development Economics, and Jaworczyk, 2004, which appeared in the American Economic Review. And these papers made the point that for FDI spillovers to happen, the channel was through backward linkages, meaning that if multinationals had an incentive to share their technological know-how, it would be to their suppliers. So technology diffusion was happening through the linkages with upstream firms. So the main difference with the relationship with the government, as Justice mentioned, is that there is no technology transfer there. So there is no technology benefit from government procurement, only a pecuniary effect. So even though it can be transformational, that relationship, in terms of relaxing liquidity constraints and providing access to credit, it's not transformational in the sense of providing technology diffusion. So it would be interesting to see and to what extent there might be a key difference in terms of the productivity growth effect of the multinational corporation subsidiary relationship versus the government relationship. Thanks.
Thank you so much. I didn't recognize that it was your PhD thesis, but I completely take it on board, and so I think I want to open it up to other people who may have questions as well, and then I can react.
Still have room for one.
Thanks, that was really interesting. I wondered whether you could, now that I know it's under review, like maybe this is not so helpful, but for future, and whether you can link getting a government contract to their tax compliance behavior, like is a firm more likely to be audited or less likely? I would guess that there could be a mechanism of, if I'm supplying to government, that's like a serious supply, and so I should now start performing better on my tax records, and like there's a sort of sense that the government is watching me a bit more closely because they're now monitoring my affairs.
Maybe together with that, I'm Kenyan, so I have to make that clarification first. But also, we see a lot of issues with government tenders, and we see some firms, getting to government contracting, they collapse after that. People have gone bankrupt. Some people have even committed suicide because of that. And your result shows, how nice and interesting it is. Maybe some comments towards that. Of course, these are aggregate effects. But some comments towards that direction.
Yeah. So,
all right. I'll allow one. Because I asked one. Please, whoever gets the mic, yeah. So after that, we close.
Is it policy implication from your paper that the World Bank should start giving much more procurement to local companies?
okay, who is watching from Washington? Okay, so let me just try and summarize, and I think you and I can talk. In terms of tax compliance, right? I think in most countries, one of the requirements for securing a government contract is that you must show your tax returns, right? And so, but I think what is interesting is to look at, in the lead up to firms bidding for public contracts, do they then try to, behave in a way as to please the taxman or not? There's a follow-on project I'm trying to do in South Africa, which is really exactly along the same thing, trying to understand what motivates firms to participate in public procurement, right? And issues on pricing and all that. But I think it's a good point that I'll take on board. In terms of your point that some firms folding up, it's an anecdote that I keep hearing. And so I'm from Ghana, right? And there's a lot of complaint that government do not pay on time. But each time there's a tender, it tends to be oversubscribed. And it's one of the puzzles that led me to this, right? So I think, yes, it's true that a government often delays in many countries, but I think the pecuniary benefit or the expected pecuniary benefits tends to outweigh, the cost, right? And especially in a demand-constrained environment where they probably don't have any major customer, they would rather take the risk. And, if you believe the law of large numbers, of course, some firms might fall casualties when the payment delays, stay on. But my sense is that a lot of the firms that bid for this government contract in Africa are aware of the constraints. But I'm not advocating that it's fine for governments to delay. But I think it speaks to the broader problem that how do we stimulate demand in our local economies? Because I think if we're able to elevate a lot of demand, right, not many firms will go for these, right? Because given that they know that these contracts, the payment for this contract tends to be delayed. And so sometimes when I present this, I like to highlight the point that I think what really is going on is not that governments are necessarily special, but it's that it really offers a lot of demand for these firms that are hitherto constrained in terms of demand. But let me stop here, and happy to chat with friends and everyone afterwards. Thank you so much.
All right.
All right. So my paper is about mobile technologies and price information diffusion in Ethiopia, analyzing the transition to 3G from 2G. And it's joint work from colleagues at the World Bank Office of the Chief Economist for Africa. And the motivation is that there is considerable promise in less developed countries for digital technologies, but limited evidence on the channels that they can affect the economies that we analyze. And in particular, in this paper, we focus on a relatively less explored channel, which is not the supply side, is not how digital technologies impact upon productivity, but rather it's on the demand side, and it's how customers and consumers are impacted by digital technologies. So we're looking at the demand side. And we want to explore how the outcomes of manufacturing firms are affected by this transition from 2G to 3G, which essentially allows consumers to go from only being able to use their mobile phones for text and phone conversations to being able to access internet and transmit media and images through their phones. And in this way, there is an expansion of information diffusion possibilities and dissemination of prices. And this will tend to mitigate market segmentation. So in sub-Saharan Africa, due to price information asymmetry, higher price dispersion is rather common because of market remoteness and missing or low quality infrastructure of both transport and communications. So there is a lot of lack of information about prices, and this means that there is market fragmentation and competition is limited. So digital technologies can reduce price information asymmetry, raise competition, and affect firm behavior and performance, counteracting market fragmentation. So in our analysis, we use both manufacturing plant data from the manufacturing census in Ethiopia and household data. And we ask if manufacturers producing in districts benefiting from early 3G access charge lower markups, had higher productivity, paid higher wages, and employed more workers. So the channel is that those districts that had earlier access to 3G communications had more competition because customers had more access to prices, and therefore markups were lower, productivity was higher, there was more employment and higher wages. And we also ask if producers that were initially less exposed to competition, such as non-exporters, small firms, and producers of differentiated products, are more likely to be impacted by the pro-competitive effect of 3G access through this demand channel. And in terms of our results, we find that manufacturers in Woredas or districts with 3G access earlier on charge lower markups by 29% and have higher productivity by 23%. The evidence on wages and employment is more mixed. And we also find that producers previously exposed to less competition experience more pro-competitive effect due to the impact of 3G access through the demand channel of reducing price information asymmetries between buyers and sellers across previously remote markets. So that's the non-exporters, the small firms, and the firms producing differentiated products. So access to digital technologies can boost competition and be a driver of economic growth. So this is the outline. I'll start with a short lead review, describe the data, methodology, the impact of 3G on Ethiopian manufacturers, and conclude. So in terms of information technology and structural transformation, there has been a documentation of the role of mobile phones in economic development in Africa through various channels to facilitate market transactions and information flows. But the channel which we explore has not been prominent. And Jort and Paulsen, in their AER paper of 2019, find that fast internet access expansion boosts employment growth across Africa. Our contribution is to examine the manufacturing census data combined with household data to explore the impact on producers' markups and productivity of expanded 3G access differentials across Woredas when the network was rolled out in 2008. And we use variation in the time when the 3G is introduced in each Woreda, and we also use industry and regional variation. So this is Ethiopia's transition from 2G to 3G. In 2007, 100% of the mobile phone coverage was 2G. 2G coverage fell to 63% after the 3G rollout, and the leap from 2G to 3G created a faster mobile broadband connection, expansion of data-enabled phones, and increased flexibility and mobility service. And in terms of broadband connections and information asymmetry, facilitating communications and allowing the spread of information via multimedia services was key, reducing price information asymmetry between buyers in different districts and regions and between buyers and sellers is the fundamental channel that we explore, and increasing competition among firms and boosting firm performance. This is the evolution of coverage of 3G after it was introduced in 2008. And this is, to put in context, the comparison of Ethiopia to the rest of sub-Saharan Africa. So you can see clearly that in comparison, it lags behind. So this was an important change in the context of Ethiopia. And as it moves towards 5G, it's an important piece of evidence that we uncover as to how the upgrade of the digital technology network will provide new opportunities. So in terms of mobile broadband growth and GDP growth, here you can see in the left-hand side panel, mobile connections and subscriptions. And we have in blue smartphone connections, and in orange mobile data-only connections, and in gray mobile internet subscribers. And on the right-hand side, we have the annual growth rate of 3G connections in blue, and GDP growth as well. Okay, so that brings us to the methodology. So we do both differences in differences and triple differences. So the differences in differences looks at the impact of internet access on markups, productivity, wages, and employment. As I mentioned, we find a robust impact on both markups and productivity, but not on wages or employment. And we do triple differences to see if there is a differential effect on firms that are less exposed to competition, such as non-exporters, small firms, and producers of differentiated products. And as I mentioned before, we matched two data sets, the manufacturing census data and the household consumption and expenditure survey, which we use to get the per capita mobile expenses on cards, mobile cards, and apparatus to identify the boredas where the 3G rollout took place earlier. So the key results are first a 29% decline in markups,
Okay, so
23% rise in productivity. And this is consistent with the key channel that we highlight, that expanded mobile broadband boosts competition mainly by reducing price dispersion and information asymmetry. And price dispersion was lower after the introduction of 3G mobile technology. Mobile broadband expansion by reducing price information asymmetry intensifies local competition, lowering markups and raising firm productivity. But our evidence in terms of wages and employment was inconclusive. And the interpretation that the mechanism is through the demand channel through intensified competition because better access to prices seems to be corroborated by the stronger effects for non-exporting firms, for domestic firms, for small firms, and firms producing differentiated products. And this is suggestive evidence that digital technologies could substitute for missing or low quality infrastructure. So there could be a leap. How much? Okay. There could be a leap in terms of going to more advanced access and upgrade of technologies for mobile communication, which could be a substantial catalyst to reduce market fragmentation. And the market failures, particularly associated with information asymmetry created due to remoteness, could be mitigated. So this evidence is important in that regard, which brings me to the conclusions and policy recommendations and questions about whether digital technologies are just like any other infrastructure. So in terms of the impact on economic outcomes, this evidence is suggestive that actually digital technologies could be transformational because they can create the conditions for market integration where before you had segmented markets due to remoteness, high transportation costs and transaction costs, and a situation of market fragmentation. So you can see that there is a sharp reduction in markups and a boost to productivity. And in many sub-Saharan African countries, price information asymmetry is common due to market remoteness and missing or low quality infrastructure. So this evidence is relevant. The existing literature focuses on supply side influx. So this evidence that we provide on the demand side is important. And so the key implications are that digital technologies can be a catalyst for market integration, and future research on digital technology should look not only at the supply side effects, but should also focus on this demand side channel that we have highlighted in our paper. Thank you.
Now that we don't have a discussant, I want to believe you received the email with her comments. So then
I haven't received it.
All right. I'll make sure it's forwarded. I'm copied in the email, so maybe she got the email wrong. So, but maybe then we could have a few more questions for this presentation. Yeah, we are opening up for question and answer for this presentation. Awesome.
When did you send it?
All right. Yeah. So for now, we can get the question and answers from here.
Yeah.
Yeah. Then you.
Okay.
So if you can explain a bit more on the channels behind the markups, right? So is it that now these feds is it coming from like an information side, right? Or it's coming from say complementary technologies that these feds are able to use to dig down on their costs, and so they don't feel more or less compelled to necessarily charge higher prices per se. I would like to hear a bit more about the intuition behind and the reduction in the markup, because I think it's very interesting.
Yeah, I have a question on the sample. I was wondering why you focus exclusively on manufacturing firms, obviously because that data set exists, I know, but why not just in principle using other data to look at similar mechanisms for other sectors as well, especially given manufacturing is only a rather small sector in Ethiopia.
Yes, so there could be a supply side effect. So it could be that these manufacturers, because of the transition from 2G to 3G, have market expansion or have access to new customers or have access to new technologies or in other ways experience a productivity boost or a cost reduction. So that would affect their cost structure, but not necessarily their markups, because the markup is the difference between the cost and the price, which is what we see is reduced. We don't believe that if it was only a supply side channel that would affect markups, that would affect the cost as such and not necessarily the markups. For the markets to be impacted, there has to be an impact on competition. And we don't have a way of providing causal evidence in terms of showing that the customers actually received more information about prices, and this is what induced manufacturers to charge lower prices for their goods and to boost their productivity through intensified competition, because we do not observe it. So because we don't have direct access to variables that let us test these hypotheses on the mechanism, we do triple differences, which is to see whether there are certain types of producers that are differentially more exposed to this channel that get affected to a larger degree. And our evidence is consistent with the idea that the demand channel is operational, which is to say that the producers that were initially less exposed to competition are the ones that see a more substantial reduction in markups and a more substantial increase in productivity. And in terms of why we focus on manufacturing, it's because that's the data that we had access to. But I agree that it would be interesting to see whether other types of producers, for example, in agriculture or in other sectors, were also impacted. And it would be complementary evidence to see how transformational the impact of the transition from 2G was in the rest of the economy, not just in manufacturing. I think that would be fascinating. Yes, thank you.
All right, I think we can take that last one. You have maybe 2 more minutes.
Yes.
Yeah, we try to.
Sorry, I'm from Ethiopia. Just I want to share some local context in this slide. since you are focusing on the manufacturing, and they try to present like kind of Warada level analysis where Warada is the second from the lowest administrative. So that might be somehow misleading in case of manufacturing, especially manufacturings they are concentrated in different, maybe in some few places, and then I think the why. Okay, that the location would have different factors, infrastructure facilities around the urban areas, something like that. So I know you are the household data have the Warada. So I don't know, presenting in maybe in Warada context, this might be somehow misleading when it comes to manufacturing. I mean, specific to the manufacturing context. That's okay for the agriculture or others, but for the manufacturing, that may be misleading. Thank you.
Okay, so you mean that we should have a more disaggregated level of geographic observation?
Yeah, better to go out than to.
It's too aggregated, the Wareda, or?
Yeah. Okay.
The issue is you have, maybe I don't know, I don't have exactly the data, but it is only in a limited number of areas that you have manufacturing firms. Right. Very, maybe few when compared to the larger, the bigger country. So I don't know how, okay for the households data, but for this manufacturing data, that is maybe, I don't know how.
Yeah,
what would be.
I don't have the map here, and unfortunately my co-author, who is from Ethiopia, is not here in this session today, but I remember from looking at the map that we had a fair degree of geographic dispersion, but maybe we can talk afterwards. And if Wobet, my co-author, who is from Ethiopia, comes later on in the afternoon, we can continue the conversation. But we used both industry and regional variation to identify our effect. So we should continue the conversation about that. Thank you.
Sure. All right. Lastly, going to look at improving access to new technologies. It's an experiment that was done in Kenya, considering the case of maize seed retail markets. Michael Ndegwa from CIMIT and my CIMIT colleagues. And also we have some partners who are in the room. We have Anemi from Sussex University, and we also have Hope from University of Illinois. Sarah again was to make this presentation, but she couldn't travel. So, so the retail farms do drive economic growth. That is in terms of creating jobs and also incomes, and particularly in developing countries. But also they go beyond that. They do influence the access to new technologies through their stocking decisions. And particularly for the case that we'll be considering today, clearly the end users, who are the farmers, depend on what the retailers do stock. So if they stock new, then they can access. If they stock old, then they'll have to stick to what then is available. So, but these farms do encounter challenges that may restrict their ability to stock newer technologies or newer products, ranging from credit constraints, and also they are highly under-specialized, stocking risks, low margins, high rates of exit, information constraints, amongst others. And also, they do operate in a market that has uncertainties in terms of demand, and especially having to stock something new. They are quite uncertain whether it will be taken or not, and particularly when you're talking about seed, which they sell within a very short window, then they do have that uncertainty. But also, there is limited research on the interventions that could influence product variety and customer service in these farms. So, and maybe to then set the stage, we are talking about maize seed retailers, particularly in Kenya. We commonly call them agro dealers, others call them agrovets, agri dealers. But for this paper and this presentation, we'll stick to agro dealers. So, and we in Kenya now, and I think most of East Africa, we have been very successful in developing and deploying new hybrids, and particularly for maize. So every year we have quite a number of new releases which are hitting the market in terms of new products. And these products, they go through rigorous breeding process, of course. And towards the tail end, they also go through a rigorous trials, both on-station and on-farm trials. And these trials show that these new hybrids or the new seeds, they have potential above the old hybrids that farmers have been growing. They do perform better from researcher-managed trials. So that, again, the adoption of these new hybrids or new varieties is associated with positive effects on farmers' outcomes in terms of productivity and well-being. We also have an advanced seed systems to deliver seeds to the farmers with quite a number of private seed companies ranging from parastatals, maybe parastatal, it's one mainly. But again, we have domestic companies and we have multinationals who are producing seed for and distributing seeds to farmers. We also have a very elaborate distribution channel, which has hundreds of distributors and thousands of agro dealers or the stockists who do the last mile distribution to the farmers. And also the adoption of hybrids is very high. And like other places or other crops, the main struggle here is not moving farmers from local varieties, but this is moving them from old hybrids to newer and more adapted hybrids. So the second generation problem, I think I've mentioned in passing, is that the old persists in farmers' fields. The weighted average age of the products that farmers are growing is around 17 years, which in 2010, which seems to go down to 13 years in 2013. But from the surveys that we've done currently, it's back to between 18 to 20 years. So it's a challenge that could be leading to this. Or to the problem of the slow varietal turnover, mostly is information environment. We have an environment where we have new releases hitting the market, joining already a wide range of choices or options for farmers. But again, there is no information that that is accompanied with these new releases that shows the comparative performance of these products that could help the farmers then to make the choices. So we have new entering the market, widening the options, but no information. So again, the farmers that we are talking about, they are mostly subsistence farmers producing mostly for their consumption, surplus that goes to the market. And they are also averse into trying new varieties. And I think that's why we need the intervention that would help them to be drawn to the newer products. They are also very attentive to choices available in the retail spaces, Mostly they just appear and outside the door they just shout the product they want. And if it's not there, they mostly move to another shop. If it's not in the whole market, they'll try go to another market. It's when they are really frustrated, they could consider then what else is available. And that's a challenge when it comes then to switching to anything different. So again, even at the retail spaces, it's the same problem. We've mentioned this, agro dealers, they have stocking risks because farmers are rarely seeking new. If they have unsold stock at the end of the season, there are no return policies. That's a risk and a loss to them, and also liquidity constraints. I think they would rather put, if they have any capital to take risk on, chances will not be in seed, particularly maize. It will be elsewhere. So, and again, even them, they have information constraints of the products that are coming to the market. Are they really fit for their farmers? And lastly, the product that you're talking about is highly important. But again, in terms of markups and the profits they would make, it's mostly from other products. But again, you need it for you to keep your farmers. I think in a hardware environment, this could be like cement. It's highly important, but it's indeed very low in terms of the markups they would make. So, but again, what some work that have been done by our colleagues shows the few times that agro dealers engage their farmers, they are successful in helping them change or switch from one product to another. It rarely happens, but the few times that happens, they are successful in influencing the farmers. And so we've been running a variety of studies then to evaluate different ways or models of encouraging or accelerating variable turnover. So here we are talking about one of them, where we conducted an RCT with agro dealers. And here we are giving them a 10% price discount on newly released maize hybrids, and we give a list of new products in the market to a control and a treatment group. But there's the treatment group on top of that. We also offer them a 10% discount if they stock the new promoted product. The question here is, how does this then influence their stocking behavior? And if there are changes amongst agro dealers, does that then reflect in farmers' choices and purchases? So, and I think I've already mentioned this. Maybe the only thing to clarify here, this was a cluster randomized RCT with 342 markets. Shops which were in one or two markets, and the markets here are the clusters. So we worked with a seed distributor who then helped us to get to this sample, but also he was the one who was distributing to these agro dealers. And we have two groups, as mentioned already. So for the seed that we used in terms of selection, we did a scoping work back in 2022, and we talked with agro dealers here and other stakeholders, including farmers and the National Agricultural Research Organization. And the criteria for selection of the products to promote is that they had to be new, that's 5 years and below, not widely adopted. But again, they were promising in terms of performance. So we talked to agro dealers, and we didn't want something that has zero presence in the market, but we needed some feedback from a few farmers. And so the agro dealers would tell us what products are new, just entered the market. Of course, we had data from the regulator to know the year the product was released. But again, the feedback from farmers that these are good products, we think that can fit our area. But again, it needed to be available in the market such that after we are done with our study, if there's a high demand, then the product is available. But of course, supply side challenges are another different thing, which are outside the scope of this study. I think I'll pass this in the interest of time. So for the analysis, in the season of intervention, that's in 2023, it's only 164 dealers who bought through the distributor that I talked about. In as much as we had a wider sample, it's only 164 of them who bought through this agro dealer, through this distributor, and they are the only one then whom we could know their stocking decisions. And so we consider this to be our main sample for this analysis. And then, but again, we check whether the treatment was correlated in any way with decisions to procure through the distributor, and we see that it was not. And also the balance between the treatment and control groups, it's okay. There was a balance. There are no biases in randomization. So we use OLS for this for the analysis. And again, it's a kind of uncover. We have the large value of the outcome variables included. But again, we use PDS lasso to select the covariates that are relevant for this analysis. And of course, we cluster the errors at market level, which are our clusters. So we have effects at two different stages: effects on the agro dealers, and then effects on the farmers. So, and the discount nudged the agro dealers to search for more information. I think it could be the channel towards them, stocking beyond being given a discount. I think they're also conscious what is it that they are stocking for their farmers. And so we see that those who are in the treatment group or those who got the discount, they were more likely to seek further information about the products that we were promoting. And these included visiting demos site for any other promoted products. They were likely to seek information about newer products. And then also the discount increased the stock of the promoted products. And this is both in extensive and intensive margins, from 72% to 89% of the agro dealers in our sample. They were likely to be stocking one of the promoted products. And in the intensive margins, the discount doubled the share of the new products in the total stock at the shops. Again, the discount, that's going back, good. So we do not see effects on the prices of the products. So there's no pass-through. They seem to be retaining the discounts for themselves. So we also had, besides collecting data from agro dealers and from farmers, we also had mystery shoppers who visited these agro dealers, both the treated and the non-treated agro dealers, pretending to be farmers. And we had 3 rounds of visits per shop. In the first visit, the mystery shopper was looking for one of the popular variety or maize hybrid in the area. The second round, this will be a different mystery shopper, but they will not identify them. The shopper was asking for a recommendation, like, I'm new here, I'd like to know what's the right product for this area. And the third visit, the shopper was looking for a commercial varieties, like, I'm a commercial farmer, what is the best for me in this area? And we see that the treated farm agro dealers, or those who received a discount, they were more likely to recommend or mention one of the products that was the new products that were being promoted here. Then effects on sales, and now this is the farmer behavior. So the discounts increased the sales of the promoted products. So this is the match during the season of intervention. So and we see there was an increase in sales, both along the extensive and intensive margins. And the extensive margin, it's pretty much the same. They were stocking, and we know whatever they stock, they do sell. So it's the flip side of the same coin, what we are seeing here. But the likelihood to be selling the new increased significantly, as did the share of the new in the sales data that we got from agro dealers. So then we did follow up a season later, no intervention, just data collection, and we see the increase in sales was sustained, both along the intensive and so the likelihood to be selling, but also the amount of sales. In conclusion, so a modest discount, margin discount offered to seed retailers increased farmers' uptake of the new products. Then the discount nudged agro dealers to one, search for information, two, stock the new products, but again, interact with their farmers more. And lastly, in a context where information on commercial hybrids is missing, public extension, again, it's challenged, almost collapsing in Kenya after the devolution, government devolution, and agriculture is one of the devolved functions. So extension services have really gone down. So then agro dealers can be leveraged to reach farmers, particularly with information about seed products. And it's a cost-effective way. I think that's one of the things we are seeing. We've done a number of studies, some of them intervening farmers directly in their farms, others intervening farmers but at the point of sale, and this one is intervening directly through agro dealers, and the POS intervention seems to be cost-effective. I think I'll finish at that. I'm sure I didn't take all the time, so sure. Thank you.
Great, thank you very much for the presentation. So just to summarize, this paper is using a randomized control trial to study the role of small enterprises or small retailers in encouraging the adoption of new technology, in this case seeds, by farmers. The treatment is that these dealers are offered a 10% subsidy to buy 4 new varieties of hybrid seeds. And it finds that this subsidy makes it more likely that the treated dealers, not farmers, stock the hybrid seeds. These seeds are a larger part of their sales. The treatment effects are larger for more risk-averse dealers. The dealers keep the selling prices the same, pocketing the subsidy. There's some evidence that treatment induces more sort of information acquisition and more effort to sell the seeds to customers. And the treated dealers are more likely to stock the hybrid seeds in the next season. So there's some persistence there. In terms of the contribution, and what I really liked about this study is that it looks at the dealer side, while most work has focused on farmers. It's a market level intervention, so it's actually done at quite a big scale, and they made effort to reach all the dealers within a market, so that prevents spillovers. And I really liked the mystery shoppers. I thought that was a really clever way to understand how the businesses actually responded to different types of farmers. It was a really innovative component of the study. So in terms of my comments, I think I have sort of 3 major comments. The first was really about the intervention compliance, because it seems like actually, I keep saying farmers and I meant dealers, but the treated dealers didn't buy from your distributor. And I wasn't really sure why that was, because it seems like a lot of them even purchased the hybrid seeds from somewhere else. They just didn't purchase them from your distributor, and you needed them to purchase from your distributor to actually get the discount. So it seemed like a lot of dealers were purchasing the seeds and then not getting the discount. And I didn't really understand why that was. Did they not trust the research team? Did they not understand the treatment? Did they not understand they were getting a rebate? Like, it seems like if you're going to get 10% off if you purchase from like this distributor instead of this other one, like why didn't all of the dealers purchase from your distributor? Is it that just that it was too much of a hassle to get the rebate, or maybe they have strong relationships so they don't want to switch? Secondly, I was kind of interested in the profitability of the hybrid seeds, because it seemed like actually they had quite similar prices and similar margins for the dealers. Sometimes actually they had lower margins sort of selling these new hybrid seeds than they would have done on some of the older variety of seeds. So it kind of made sense that the dealers wouldn't really want to put effort into selling the new hybrid seeds if they were making, if anything, a lower margin on them than they were on older products. And I just wasn't really sure why that was. So I think maybe if you gave a bit more background, kind of explaining how prices were set for these different seed products, sort of like how competitive they are, it might just help with understanding kind of how these seeds were being priced and why dealers weren't able to make sort of a larger margin on the newer hybrid seeds. Particularly because it seems like if these seeds are sort of superior and have better characteristics, it didn't make a lot of sense why the pricing was the same as kind of the older, worse seeds, at least to me, and I don't know a lot about seeds. Can you do any sort of back of the envelope calculation as well about how much profit the dealers actually made from selling these seeds, like with the subsidy and without it? So would it even be profitable for them to sell these varieties at all if they didn't have this subsidy that you were providing? And the fact that it doesn't really seem profitable to the dealers suggests that you might need to intervene on the farmer side. So I know you said it's quite cheap to intervene on the dealer side, but it suggests that if this wouldn't be profitable otherwise for the dealers, then you might have to intervene kind of on the farmer side instead. My last big comments on the analysis. So I know that you did a restriction in all the results you showed today as well, where you restricted to only dealers who purchased from your distributor. And I just don't think it's valid to do that restriction, even if you do kind of a balanced test and like a regression that treatment doesn't predict who you purchase the seeds from. You have quite a small sample, so you're very underpowered when you do those balanced tests. So the fact that, you can't reject balance, I think, doesn't mitigate this concern. I think that one thing you could do is interact treatment with sort of characteristics of the dealers and see if the sample composition is changing in terms of who's buying from the distributor. But I think a better piece of analysis would be if you had data on who they purchased from previously, is just to restrict the sample by kind of prior purchase from your distributor rather than sort of purchase during the study from the distributor, because then that would be predetermined. There wouldn't be any concerns about the sample selection changing. So if you did that, and if there's a lot of sort of inertia in changing distributor, then the results might just end up the same and it would get rid of this concern. Lastly, I think it would be really nice to know a bit more from the farmer side. Like you had these sort of intercept interviews that you did with the farmers, and it seems like a lot of the explanation must be on the farmer side. Like if these seeds are better for them, like why are they not buying from them? So I think a little bit more kind of digging into the farmer side of the story is necessary to understand the dealer side as well. So thank you very much. It's a really nice study, and I think it's it's got a lot of interesting questions. Thank you.
Thank you. All right. Why didn't they purchase through the distributor? So as we were going in, actually, we had a feeling like this is the main distributor in that area. And indeed, I mean, when we asked for a list of, the agro dealers that they do supply to, they gave us a list of, all the markets, that were within the areas we were targeting, and almost every agro dealer was in the list. But later again, when we were in the field, we realized it wasn't anymore. But those are some of the things had to change along the way. It seems quite a number of agro dealers have moved on to other competing distributors, and one of the issues could be the trust that you're talking about. But again, they had already developed, stronger, connections with other distributors, so it's hard to convert them. And this study also involved us, making sure that the distributor has stocked those products. such that when the agro dealers needed, at least those ones are available, and doing that with multiple distributors, and especially if you had not, you didn't foresee that while designing the study, was quite hard. That's why we stuck with what we had. Similar and lower margins of new seed. I think one of the things we are realizing, I think breeding is quite a huge cost in seed production. But again, most of that cost is shared by the public sector, particularly in Kenya. The government, we have CGIR where I work. So it seems most of that cost it's covered through public breeding. And so the only cost that remains then is the actual seed production, which doesn't differ between new and old seed. And we tend to think that's the reason why, because there's no major difference in pricing between old and new seed, and we tend to think that could be one of the reasons why. But generally, we observe like the parastatal, the government seed company, generally their seed is slightly lower compared to others. Again, it can be explained. It's a government seed company, and so there's a lot of investment from the government there. And I think, but I think it's something that we could look at, especially given we see some minor but differences in pricing, and particularly the season we went to do this. There was a shock in supply and seed prices, almost doubling in some cases, which was quite significant across. This affected, so an effect across all varieties and all seed companies. But we could check further what's happening there. From the farmers side, I think this study relies 100% on data from agro dealers, but as I said, we had other studies where one of them actually we gave a similar discount, but directly to farmers around the same season, of course, different markets, and we see similar effects when you intervene again through farmers, directly. We see that increases their demand for the new, but particularly to go and experiment. They will buy one packet, or two, and they say mostly to go and experiment. But we see there's also potential for that, and especially now, again, if the intervention is at the point of sale, so then the cost, is not as high as compared to intervening directly in their farms. Yes, I think restriction of the sample, I think that one we take, and I have my colleagues here who we are working on this paper together. I think we will take that concern and do further checks. I think I like your idea of interacting with the prior purchases, having prior purchase from that distributor in the past. I think it's something we can look at, but it's one of those limitations in a paper, which is a huge one for this particular one. I'm not sure whether Anemi and Hope you'd want to make any comment. Awesome. I think then we can open the floor for one question. Can take two. It's start with him and then go to Barbara.
I already had a question before. So
okay.
One or two questions.
We can take both of them.
Okay. Yeah, just a quick question. I would follow up on the final point. I was wondering how much more productive farmers are with the new seed variety, because in order to judge the cost effectiveness of the program, then maybe very good program. Even if the retailers don't pass through the lower price to the farmers, if in fact the farmers are much more productive using the new seed variety. I think that's a crucial element that you would need to highlight in your presentation.
Yeah, if new varieties get released, every few years, or if there's like 10 varieties being released, say, every 3 years, of the same crop, then how sustainable is this going to be to give a 10% discount every time a new variety is going to be introduced? Like, who's going to pay for that? And I think sort of the bigger question is, what is really the underlying constraint or market imperfection that makes that agro-dealers aren't pushing for the latest varieties, and how to address that underlying constraint is maybe the big question. And sort of you getting at it, I think, with the 10% discount, but that's not going to be sustainable for every new variety that's coming out there.
Yeah.
So something more fundamental needs to change probably. Can you say what that is?
Okay.
$1 million question.
All right. The good thing, you are also a partner in this work, so I'll come to you for further discussion. But maybe I'll start from, I think, from there. I think the idea here, and I agree, I think 10% in the long run is quite high. But again, seed companies do incur, huge budgets when they really want to push a new product in the market. I think this is a way we are evaluating this as giving them one other way that you can try to push a new product to the market, that agro dealers are actually, effective. They can help you reach the farmers. So yeah, they would need to see where they've been putting the monies that maybe didn't pay that much, and this is one of the areas that they could focus on. But then again, if it's done over time, we hope it could lead to behavior change among agro dealers, and especially if they realize that every time we do this, then we are able to convert our farmers. And for sure, if it's a really new, good product, because they do care about their reputation and their business, so they would need to have a return, farmers. So we also hope maybe if it's done, of course, not once like we've done, but maybe done over time could lead to a behavior change amongst agro dealer to appreciate. For sure, I have capacity to, introduce something new amongst my farmers, and if they're successful, then I'll keep them and improve the reputation of their shop. And how productive are the farmers who grow these new products? I think that's another very good and interesting question, and it's something we are actively exploring at the moment. But data from on-station trials and also on-farm trials, but again with researcher engagement, tells us they are good. And of course, we do expect new is better. Because, some of the products which are in the market are 40 years old or in the market, and then the climate was totally different. And currently, the ones which are being released, they're drought resistant. We have new diseases, in their production conditions. So they also bred against those. Like we just released like fall armyworm resistant maize varieties. MLN resistant, those are things which were not there those years. So we believe new is better. But at the moment, when it comes on farm, I think it's a whole totally different story. And we are at the moment designing some studies to test that further. The presence of these genetic innovations on farm, and that's not just trials, but farmer fields. It's something we are actively exploring at the moment. But so far, we have every reason to believe new is better. And I see one person who can't wait to clap for me so that I can let you go ahead. All right, I think we'll close it at that and wish you a good evening, a good rest of the conference.